Well, if I were a farmer, I'd have lots of optimism because spring always brings optimism if you're farming, right? There's always the new crop. This year, for the mortgage industry and real estate to some degree, there's some optimism, but it's being really squashed by all these reports that keep coming out about inflation not coming down as the Federal Reserve has expected. And of course, a result, no lower expectations on how many times the Federal Reserve might drop interest rates, their federal funds rate, and when. Right now, the market is only factoring in 2 rate cuts this year instead of the 3 that they were expecting when the year started, based on what Federal Reserve Chairman Jerome Powell said in December. Now, why is that? Well, it's because these inflation reports keep stalling out or going the wrong direction. And that particularly happened in particular with the CPI report last Wednesday. I'll show you the charts on how that affected interest rates in the bond market because it was a pretty large reaction to it. But here's what happened. On the chart here, the headline number came in at 3.5% instead of 3.4. Last month, it was 3.2. So the markets were kind of expecting it to get a little bit worse on the headline, but not that much worse, right? Not up to 3.5% for the headline inflation. They look at the core inflation where you strip out food and energy, which are more volatile, and that stayed the same at 3.8%. The market was expecting the core to drop to 3.7 because the core inflation on the CPI and the PCE reports is what the Fed watches, but it didn't. It stayed the same. So why is that? Well, most of that is due to oil. Oil prices pressuring the prices of goods and services and shipping and everything that's involved in that up to the point where it's affecting the whole ball of wax. Additionally, there were some other reports that came out last week that were not helpful. Right, there was a New York Fed consumer survey that came out. Expectations for rent increases next year rose dramatically, and it's probably not. It probably makes sense if you think about it. I mean, a lot of these owners of these large apartment complexes and buildings, these are commercial buildings. And what's happening with commercial loans? You probably heard about this in the news. Well, there's a crisis in some areas, especially in the country, in some sectors, including multifamily, but especially office and maybe even warehouse space, where these commercial lenders and banks are resetting their rates. Those rates are not fixed for 30 years like a residential home is. Rates on commercial loans are 3, 5, 7 years fixed, and then they reset. They have to be recast or refinanced. And so there's a lot of refinancing that has to happen this year, restructuring of these commercial loans going into next year as well. What's an owner of a building going to do, right? Their payment, their debt service is going to increase probably fairly dramatically. Why would they drop rents unless they have a ton of vacancies, which they don't because there's a shortage in general of housing across the country. So it probably makes sense that we're not going to see rents come down much more. They may trickle down a little bit more, but probably not as low as like Apartment List or some of these other data collection companies are thinking they'll drop between now and the end of the year. And that's a big component. That's like 43%, right, of the core CPI is rents and rent equivalents. That is just not weakening, and these reports last week are kind of strengthening that at the same time. So there's also on Tuesday, there was a small business optimism index that came out really low, like an 11-year low, because there's so much concern about inflation not going away and not having much relief on interest rates. Now, having said that, the Federal Reserve does have a couple of tools, right, to keep a lid on bonds. One of those is dropping the federal funds rate. The other one is every month they have billions of dollars of bonds that they've previously invested in that are coming due, that are maturing. When those mature, they have profits that come from that maturity. In the past 2 years almost, they have just been allowing those profits to kind of run off into the market. They have not taken those profits and reinvested those in buying new bonds or treasuries or mortgage-backed securities. But in the most recent Federal Reserve meeting minutes that we've seen over the past week or so, it's becoming evident that the Federal Reserve, at least half of the members, voting members, are looking at finding ways to, in fact, the majority of them are looking at finding ways to invest maybe up to half of that runoff every month into new purchases of treasuries and bonds. That would at least keep a lid. I don't know if it would drop the interest rates much. It might drop them a little bit, but it would at least probably keep a lid on interest rates and bond prices so that we don't see interest rates continue to get out of control. And hopefully they don't get up to 8% and higher like we were starting to see last fall, right? That's, if we can keep them 7 or lower, that would be best. So that is what's coming down the pike as another tool, another way the Federal Reserve can keep a lid on things and keep kind of control over the overall long-term interest rate environment. So thought that might be an interesting piece of information for you to consider. Okay, so let's take a look here at this next chart. And this is the charts that I just want to show you what happened last Wednesday. So the universal mortgage-backed security chart, of course, that's the 30-year bond. Last Wednesday, here's what happened. This is the price. When the price drops, that means the yield and the rate is going up. We had a huge drop, probably the biggest drop we've had. In fact, the biggest drop we've had since, boy, for a long time, for like 6 to 9 months. So we had a huge drop in mortgage-backed securities last Wednesday because of that CPI report coming out. So there's obviously a lot of pent-up positive expectations in the market that were not met, and that all had a huge knee-jerk reaction last Wednesday. There's been, and it kind of stalled out on Thursday and Friday, and then there was follow-through yesterday and a bit today. So could we see it get even worse tomorrow? Yes, possibly. We are breaking through these Fibonacci levels. At some point, it will catch and bounce. Will it bounce all the way back up here? Probably not right away, but it would not surprise me to see somewhat of a bounce at some point here in the next week or so. We'll see what happens. Obviously, as we get data going into May for April, that could change the trajectory. Hopefully that shows improving, inflation numbers. Again, if it doesn't, then yeah, you could see it get even worse. I went back 6 months here just to show you. This was last October when we were seeing rates around 8%. We're not even close to that at this point. Rates are right around that 7% range for 30-year fixed mortgages right now. I hope we don't see it drop that far. If we do, we'll be looking at a replay of last fall. So that's the news for today. We're in trying to find a catch here to turn it around over the hopefully next few days. But if you have clients who are looking to looking to buy and need to purchase or close in the next 2 weeks, it still may not be a bad time to lock. Hopefully they're working with a lender like me that offers a free float down so that if rates improve over 0.25%, they can take advantage of that for free through the lender that they have. Some lenders offer that, some don't. So that's something to check on for them. And those that are out that were pre-approved, let's say 2 weeks ago, they're out shopping for homes, make sure they double check with their lender to make sure they're still pre-approved, because rates have gone up a good 0.5% since then, and that could affect their pre-approval. In some cases, more than 0.5% over the last 3 weeks, depending on the loan program. So just make sure they're still pre-approved. So that's my advice for today. Outside of that, that's the discussion for today. I'm sorry it's not as positive as I'd love to share with you, but hopefully things turn around at some point here in the near future, and we do see an improvement in the outlook for interest rates as we go forward. I guess the flip side of the coin, the silver lining, is apparently we have some pretty positive employment data. That's part of the reason why the market's reacting the way it is too, from a week and a half ago when you had those strong jobs numbers and lower unemployment rate. If that's true, and we actually do have a strong economy as these numbers are leading us to believe, I guess that's good news. So it's better to have slightly higher interest rates and a strong economy. But I guess we'll see over the next few months whether or not we really do have as strong of an economy going forward. Any questions, feel free to reach out to me. I love visiting with you about this information and would love to answer any questions you have. Feel free to shoot me an email or call me, 208-861-1446. And don't forget to follow me on Instagram, where I'll keep you updated on stuff like this as we go.